Good afternoon or good evening, depending on where in the world you're catching us from. We have got viewers from the US, from Europe, from Asia, Africa and the Middle East. So wonderful to see all of you. I'm Khoo, and welcome to this webinar on how to trade options for beginners. Okay, so my job today is to show you how to understand options in a really simple way so that anyone can use and trade options profitably. Okay, so I'm really excited to host this webinar today, and also excited to announce the pre-launch of the professional options trading course, which at the end of this webinar, you'll be getting the chance to purchase at a massive discount. So do stay all the way to the end for this great offer, right? So thank you for answering the questions that we had earlier. Interesting to note that it seems almost half of you are already trading options, and the other half of you have never traded options before. But no worries, I'll start from the basics and we're going to work our way to the good stuff towards the middle and the end of the webinar, right? So do understand that, okay, so thank you also for answering the question on your primary trading instrument. So again, whether you are a long-term investor or you are a short-term trader, whether you are swing trading, trend following, day trading, whether you're trading Forex or futures or stocks, options will give you that additional edge in the markets. It will give you that additional arsenal in your weaponry to profit in any market situation, to maximize your profits no matter where the market goes. And in fact, some of you may already know this, but do you know who the biggest options trader is? Right, make a quick guess. Some of you already know the answer, okay? And the answer is the biggest trader of options is none other than Warren Buffett, okay? One of the richest men in the world, one of the world's greatest investors. You know, many people know Buffett as a value investor, as a long-term investor, which he is. But many people do not know that he actually uses options at the side to maximize his returns and to minimize his risk. In fact, one of the strategies that he uses is to sell put options on stocks that he wants to acquire at lower prices. And we'll talk more about that in the webinar if you're not sure what it means, like what's a put option, right? We'll cover that in a while. But the gist of it is this. For example, Warren Buffett wants to buy Coca-Cola, and Coke is now selling at $50, for example. Okay, let me just draw that. Coke is selling at $50. Now, as a value investor, he wants to get a lower price. He wants to buy at a discount at, say, $45, okay? Now, most investors, what will they do? They'll put a buy limit order at 45 and hope that the price will come down to 45, or they'll wait and be patient for the price to go to 45 before they start buying the shares. That's what most investors would do. What Buffett would do is he would be selling put options at a strike price of $45. Now, some of you may be, again, not knowing what the heck a put option is. And again, we'll go through that step by step later on. But to give you a quick idea, by selling a put option, Buffett is selling a contract that obligates him to buy the shares at $45. Okay? And by selling this put option contract, he collects premium, right? He collects money up front. Now, if Coke doesn't go to $45, it stays at 50 or goes to 55, what happens? He doesn't get to buy the shares, right? But he collects the premium for free. And he keeps doing this month after month after month, collecting premium, okay? Until eventually one day, if the price goes to $45, he's obligated to buy the shares at $45 because of the put contract that he sold, okay? So by doing this, what happens? Buffett is able to acquire shares at a lower price than most people. So when most people, pay $50 for Coke, he's paying only $40. Or people are paying $40, he's paying $35. Because he collects these premiums from his put options that offsets the cost of his Coke shares, right? So again, if you're lost, don't worry, right? I'll go through that in detail in a webinar, but just kind of like tease you a bit about how Warren Buffett, the world's greatest investor, uses options, okay? And he also, during the financial crisis, when people are panicking, they say, oh my God, the world's coming to an end, And Buffett, as a long-term investor, knew that eventually the market will recover. Eventually, the S&P 500 will always go up. So what he did was he sold S&P 500 put options at a premium. So he collected up to $4.9 billion of premiums, which is basically ensuring that the S&P 500 will not go to zero, which we know it will not go to zero, right? You'll always go up in the end. And by doing that, he's able to collect billions of dollars in additional money. All right. So for many investors who are wondering, hey, how come I can't get as high returns as Warren Buffett? It's because he uses options as his secret weapon. All right. So in today's webinar, I'd like to introduce you to this world of options. And again, whether you're an investor or short-term trader or forex trader or stock trader or commodities trader, how options can now be in your arsenal. Okay, so that's my quick little introduction. With that, let's jump into understanding what options are all about. Okay, now some people may think that options are complicated. Well, everything is complicated when you first learn it. You know, when I first learned how to drive, I found it complicated. But you know, now I can drive without thinking about it, and I'm sure the same thing happens to you, right? So anything new is difficult, but once you learn it, it becomes really simple. So let me do my best to explain it in a way where it's easy to understand, okay? Now, there are basically two kinds of options. That's all. Two kinds. Call options and put options, okay? So when you buy a call option, what are you actually buying? See, when you buy shares of a stock, you're buying part of the business. You're buying an ownership of a business. When you buy a call option, you're buying a contract, right? You're buying a contract that gives you the right, right? You have the right, but not the obligation. You have the right to buy 100 shares of a particular stock, like Amazon, Apple, Google, whatever it is, right? At a predetermined price, which means you now have the right to buy shares at a price which you have locked in. And we call that the strike price. And you can buy the shares at this price that you have locked in anytime before an expiration date. All right, so that's basically what a call option is. So think of call as you're calling, right? You have the right to buy the shares at a fixed price called the strike price before or on an expiration date. So let's take a look at how people use this, right? So let's imagine we have got Apple shares. Apple is now selling at 155 on the 29th of January, okay? So you are bullish on Apple. You think Apple's going to go to 180 because it's on an uptrend, or you know, it's undervalued right now. Whatever reason, you think it's going to go 180, right? So what could you do? Well, the first thing you could do is to buy the shares of the stock, okay? So if you buy the shares of the stock, it's going to cost you $155 per share. If you buy 100 shares, your total investment will be 15 grand, 15.5 grand, okay? So that's a big investment, right? So eventually, if it goes to 180, you sell the stock at 180, and you sell 100 shares, you are selling at 18 grand, 18K, right? So 18 grand minus 15.5, what's your profit? You made $2,500 in profit. Now, you made $2,500 out of an investment of $15,500. So what's your return on investment? You take 2.5K divided by 15.5K, right? So that gives you a return of 16%. Which is not bad for 3 months, right? 2 months, okay? Now, the other thing you could do would be to buy the call options. So let's see what would have happened if you buy a call option. So instead of buying the shares, you buy an Apple March 155 call. So again, what does that mean? It means you're buying the Apple call options with a strike price of $155. So by buying this call option, you have the right to buy Apple shares at $155. You have locked in the price. So no matter where the price goes to, whether Apple shares go to 180 or 200 or $2,000, you have the right to buy at 155. You have locked in that price. Again, we call that the strike price. And you can buy Apple shares at 155 anytime before the March expiry date. And it normally expires on the third Friday of the month. So the third Friday of March. Now, of course, to have this right, it's not free. You have to pay a premium. You have to pay a price to buy the options. So in this case, the premium costs $6.20. Now, roughly, if you buy a call option where the strike price is near the market price, we call that at the money, it costs roughly about 3 to 4% of the share price. Okay, so in other words, about 4% of 155 is about $6.20. All right. So in this case, let's look at the numbers. So in this case, you buy the call option at $6.20. All right. And now each contract is 100 shares. So minimum, you have to buy 100 shares per contract. So 620 times 100 is $620. So off the bat, you are now only requiring $620 for 100 shares compared to $15,000 when you bought the shares itself. Okay. So in this case, if Apple stock goes to 180, as we expected, what does it mean? It means that you have the right to buy Apple shares at 155. You've locked in 155, but it's now at 180, which means you can buy it at 155 and sell it at 180. So in other words, what's the potential profit that you now have? It's 180 minus 155, which is $25. So now your call options that you bought have an intrinsic value of $25. Your call options are worth at least $25, but in reality, they'll be worth more because of what we call time value and volatility. But more on that later on. But the point is they're worth at least $25. Okay? Now, so what you could now do is you could sell your call options at $25. Now, you bought the call options at $620, correct? Now your call options are worth at least $25. So if you sell it at $25, how much have you made? You make $25 minus $620. You make $18.80 per call. And again, times 100 shares, that's $1,880 in net profit. So in this case, what has happened? You make $1,880 out of $620, which is the initial capital required. That gives you $1,880 divided by 620, a return on investment of 203%. Okay, so that is the advantage of using options. You use less capital and it gives you a much higher return on your capital. All right. So there are altogether 7 reasons how options can help you as an investor, as a trader. Let's run through some of these 7 reasons. Now, again, the first 2 reasons come together, which I've just mentioned, right? Reason number one, options allow you to control high-priced stocks, especially stocks like Google. You know, it's $1,000, Amazon, $2,000, Apple, you know, $200. You may say, hey, I don't have enough capital to buy the high-priced stocks, but I want to benefit from the rise of the price. You can use options, because with options, you need a small amount of capital to control the high-priced stocks. Okay, and as a result, again, by doing that, it increases your percentage return on investments. Let's look at another example just to make sure that you get it, right? So over here, we have got Intel, INTC, and you can see this was a downtrend. It went in a consolidation, and here it's kind of like breaking to a new uptrend, right? And the current price is $53.26. So you believe that it's going to go up to at least the previous high of 57.60. Okay, you are bullish on Intel. Okay, so again, you could buy the stock, okay, or you could buy the call option where you now lock in the price at 53.26. So let's take a look. How much would it cost to buy the call option? So what you do is using your trading platform. I use Think or Swim. Again, you can use Think or Swim. You can use Tasty Trade. You can use Options Express. You can use Interactive Brokers. You can use any broker that you want. All brokers will have an option chain that shows you all the different options you can buy at different prices, at different strike prices, at different expiration dates. It's kind of like a shopping, like a menu we can choose, right? Okay, so in this case, this is the option chain of Intel. Again, Intel is now selling at 53.26. That's the latest price, okay? Now, so if I want to buy the call option, I have to choose, first of all, the date to expiry, okay? Now, again, you can choose options that expire in 10 days, 30 days, 60 days, 5 months, 6 months, even 3 years. That's right. You can buy an option that expires in 3 years. We call it a leap option, depending on how long you're giving yourself for the price to go up. Of course, the longer the expiration date, the more expensive the option is. Okay. So usually when I buy call options, I would buy normally 30 to 60 days to expiration, because I believe the price would move within 30 to 60 days. Okay. Now, in this particular case, let's imagine I choose the 18 April expiry date. So this call option expires on the 18th of April, which is 27 days from today. So I'm giving myself 27 days to be right. Okay. Now, and I choose the strike price of $53. Now, again, you can choose any strike price you want, depending on your style. Some people like to choose a strike price that is much lower than the current price. We call that in the money. Some people like to choose a strike price that is above the current market price. We call that out of the money. There's no right or wrong. Each technique has its pros and cons. So personally, for me, I like to choose the strike price that it is near the market price, which is at the money, personally for me, right? So I'm choosing the call option with a strike price of, in this case, $53, which is just below the current market price. Okay, so how much does it cost for me to buy this option? There you go. You can see the market price of the call option is $1.49. Okay, so by paying $1.49, I lock in the price at $53. I can buy the shares at $53 anytime before this expiry date. Got it? Okay, so with that, let's see how that works. So again, by buying, by buying the Intel 53 April calls at $1.49, which I just mentioned, how much does it cost me? Again, $1.49 times 100, minimum is 100 shares per contract. It costs me $149. Okay, so you can see that when you use options, you don't need a large amount of capital. In fact, I tell people that if you don't have much money to trade, you could use options, because options allow you to use less capital than normally in stock trading or stock investing. Okay, so with $149, I am able to control 100 shares of Intel, and 100 shares at $53 right now is $5,326 worth of shares. So you can see again, options allow me to use little money to control a big amount of stock. Okay, so that's the first advantage. So again, let's take a look at the maths. Okay, so again, I buy the Intel 53 strike calls at $149. My total investment is $149. So if Intel indeed goes from 53.26 to 57.60, which is my target price, that's an 8% increase in the share price, correct? But here's where it goes, right? So if Intel increases to 57.60, what happens? I bought the call options and I have the right to buy the shares at $53. But now it's selling at 57.60. Okay, so my calls are worth $4.60 per share. This again is the intrinsic value of my call. So again, how did I get $4.60? $4.60 is the difference between the current market price and my strike price, which means 57.60 minus 53 is 460. My calls are worth at least 460 right now. Okay, so what's the profit I get if I sell my calls? I bought the call at 149. I sell it now at 460. I make $3.11 per call or per share. Okay, so times 100 is $311. There we go. So I made $311 out of 149. So 311 divided by 149, the answer is 208%. So again, there you go. Options allow you to get much higher return on capital. Let me just take a look at some of the questions coming in. And again, don't worry, guys. I'll answer all your questions towards the end of the webinar once I've run through the curriculum. But let me just look at some of the questions coming in right now. Can you buy options that expire the same day? No, we don't do that. You always buy options with at least 30 to 60 days to expiration, and I'll explain why later on. Okay, great. Again, keep your questions coming in. I'm looking at them and I'll answer all your questions towards the end of the webinar once we have covered most of the curriculum, because I think a lot of your questions will be answered in my lesson slides. All right. Okay, so those of you who have been following my YouTube videos will have seen this example which I gave recently, where I use options, call options, to buy QCOM. Okay, and I had 176% return in just about 30 days. So to refresh, this is what happened, right? This is from the video, by the way. Okay, so QCOM was in a range. Okay, so it's trading in this big range like so. And there was a strong support. So the price came down to about $50 and bounced off and was at 52.35. Okay, so I was bullish. I believe that gonna bounce back to about $60 at least, or eventually higher. Now again, I could have bought the shares, but I bought the call option. So how much did it cost for me to buy the call option at the time? So let's take a look at this, right? So I bought the QCOM April 52.5 call options. So again, what does this mean? It means I bought the call options with a strike price of 52.50, which means that gives me the right to buy QCOM shares at 52.50. I've locked in the price. Now, this was the 21st of April, and my options expired on the 3rd Friday of April, which means that February, March, I had 2 months to expiration, right? I had 2 months to be right, okay? So again, how much did I pay for this option? I paid $2.09. So again, instead of buying the shares for $52 per share, I now pay $2, okay? So let's take a look at what happened. So eventually you can see that the price did go up to about $58 and I took profits. All right. So you can see, okay, let me just check with my team whether the words are too small. If it's too small, I'll find a way to magnify it. Can you see this? Is it too small?
Barely.
Barely, all right. Tell you what, guys, give me a sec. Let me activate my Zoom feature so I can zoom in for you guys. Excuse me. Okay, there you go, right? So this is a screenshot from my trading platform. And again, you can see over here, all right? This was the call I bought. I bought the QCOM call options at a strike price of $52.5, expiring in April, okay? And over here, you can see the trade price, which is the price I bought it at. And I bought it at, there you go, $2.09. So times 100, my total capital was $209. And that's my maximum risk. So if I was wrong, the most I could lose is $209. And when the share price went up, right now, the current market price is $5.82. So I bought the call at $2, and now the call option is worth $5.80. So I decide to sell it, and I make a profit of, you can see this is the profit and loss, okay, of $373. So I made $373 profit out of $209 capital. So you take this, divide by that, there's 178% return in just 30 days, right? So again, it was posted on YouTube, an example of how you use call options to trade, okay? Let me look at some more questions coming in. Okay, quick question I could answer right now. Do you have to wait for the option to expire, or can you sell it before it is done? Oh yeah, you can sell the option anytime, right? So if I buy the option today, I could sell it today, I could sell it tomorrow, I could sell it anytime, okay? Yeah, you can buy and sell it anytime. In fact, as option traders, we tend to sell it before it expires because we do not want it to expire. Because when we expire, we get nothing left. Well, we do, yeah, we get the intrinsic value, but we want to sell it before that so we get some time value left as well. Let me look at some more questions coming in. Okay, great. So keep the questions coming in. I'll answer them in the slides to come. Okay, so those are the first two reasons. Reason number 3 is options allow you to achieve unlimited return with limited risk, okay? Now, let's take a look at this chart over here, okay? We call this a profit and loss chart. On the y-axis, if you remember math from school, you have got profit and you have got loss. On the x-axis, you have got the share price or the stock price, okay? And so anything above 0, you're making money. Below 0, you're losing money. So again, let's look at the Intel example again. So if I bought the Intel shares at 53.26, that would be my purchase price, which is at 0, correct? So if I buy the shares, what does it mean? If the stock price goes up by $1, I make a $100 profit. If the stock price goes down by $1, I lose $100, right? It is 1 to 1. So if the stock price goes to 57.60, I make the difference, which is $4.34. Times 100 shares is $434, okay? Now, the danger with buying the shares is that if the company goes bankrupt, now, of course, it's very, very unlikely. It's like, you know, being on a plane and the plane crashes. It can happen, but it's very unlikely, right? Knock on wood, right? If the company goes bankrupt and you buy the shares, how much do you lose? That's right, you lose your entire investment. So the maximum that you can lose is 53.26 times 100 shares. You can lose $5,326. Okay. Now, on the other hand, when you buy a call option, what happens? It looks like that. So instead of having a straight line, your loss is capped, is limited by the premium that you paid for the call. Okay. So in this case, for Intel, how much do we pay for the call option? We paid $149, right? So that's the most you can lose. So even if Intel goes to 0, you can only lose $149. All right. So options allow you to have limited risk, but for the same unlimited return within, of course, the expiration date. Okay. Give me a second. Now, so a lot of you be thinking, yeah, but Adam, with stocks, we can put a stop loss to limit our downside. Absolutely. In fact, that's what I do as well. When I trade stocks, I use a stop loss as well. And that works most of the time. But what is the danger with using stop losses? That's right. Sometimes if the price gaps down below the stop loss can't protect you. You will end up selling way below the intended stop loss price, and you could lose more than what you wanted to lose. And that could happen during earnings. When a company announces bad earnings, the price could gap down. Or if there's a sudden bad event, like again, the unfortunate Boeing plane crash, and the stock gaps down, right? So here's an example. Okay, so this was a Biogen, a biotechnology company. And what happened was they announced that their drug, their cancer drug, failed the test, right? So the stock gapped down from 300 and let's see, it gapped down from $320 to $226 the next day, right? You see that big gap over there? So imagine if you bought this stock at 340 and you put a stop loss at 300. So you say, okay, I'm only willing to risk $40 per share. That's my stop loss. The problem is, if the stock price doesn't go down to 300, you don't get to sell at 300. If the stock gaps down to 230, what happens? That's right. You can lose a lot more than what you intended. And that's the danger with stop losses on stocks, right? They work most of the time, but shit happens when this happens, okay? So by buying the option, all right, with the option contract, you can never lose more than the call option premium. So that limits your risk, basically, right? Now, when is this useful? All right, this is useful when you're playing on stock earnings. As you know, stocks, they announce earnings every 3 months, okay? And sometimes if the stock announces great earnings, the price could gap up and you could make a lot of money. Now, but the danger is that you don't know what's going to happen. They could announce bad earnings. It's kind of like a gamble, right? So if they announce bad earnings and the stock gaps down, what happens? That's why you could lose your pants, okay? So when you play with earnings, options are very useful because options give you that unlimited upside. But if shit happens, you can only lose your call premium, which is just a few $100s, okay? So again, take a look at Netflix. So for Netflix, you can see that it was trading at $100. Great earnings, it gapped up to 116. Wow, $16 overnight, okay? But look at Kraft Heinz. This was a stock that Warren Buffett owns, right? It was at $47 and they announced earnings. What happened? The opposite happened. It gapped down to 35. So overnight, you lose 26%, okay? So that's the danger of playing with earnings, right? But with options, you no longer have that risk. With options, you can only lose your premium. So a couple of days ago, my buddy and the co-creator of this course, Bang, we just call him Bang, not Bang, Bang, although he likes Bang as well, right? Yeah, this video, he made 400% returns by buying the JP Morgan call options. And he made 400% return in 5 freaking days, all right? And basically, the reason he bought the options is because JP Morgan was going to announce earnings. So he expected that they would announce good earnings and the price would jump up. So he bought the call options. But you know what happened? Even before the earnings announcement, the price already jumped up, right? And because he made 400% in 5 days, he said, heck, you know what? Let's not be greedy. Let's just sell and take my profits, okay? So if you watch the video, you can see basically that's what he did over here. Where was that? That's right. So yeah, this JP Morgan, and he bought the 105 call, right? Which means that he's locked in the right to buy the shares at $105. Okay. Now, how much did he pay for it? Over here, you can see he bought it for 29 cents. That's all. He paid 29 cents. So again, if you multiply that by 100 shares, that's $29. So when people say, hey, you need a lot of money to trade options, I say, no, you just need $29 to buy one contract. That's it. Now, of course, Bang's a bit greedy, right? So he bought 20 contracts, right? Sorry, he bought actually more than that, I think. I think he bought 30 contracts, something like that. Anyway, so yeah. So what happened was he bought it at 29 cents, and the market price in 5 days is now $1.08. Okay, so times 100, that's $108 in 5 days. Okay, and because he bought 20 contracts in this particular example, you can see that he made $1,500 in profit in 5 days, right? Yeah, so it can be really profitable if you know how to use that. Okay, now, are we okay so far? Are you guys following me? Sorry for my cold. I think I caught it from my kids. Let me take a look at some more questions coming in. Okay, I think I answered that first question. Okay, great questions, guys. You guys have great questions. And again, I'm going to cover most of it in my slides to come. And if I don't, I'll answer them towards the end. So keep the questions coming in. I love your questions. Okay, good. So reason number 4, with options, you can profit in any price direction. So with that, let's talk about put options, okay? So call is you're calling the shares. You have the right to buy. Put is you're putting, which means you have the right to sell. It's the opposite, okay? So what are put options? When you buy a put option, you're buying a contract, okay, that gives you the right. So again, you have the right, but not the obligation, right? You have the right to sell 100 shares of stock, or again, could be Forex, could be commodities, whatever it is, right? You have the right to sell 100 shares of the stock, in this case, at a predetermined price. Again, we call it the strike price. So you're locking in the sales price. And you can do it anytime before or on the expiration date. So let's take a look at how you can use this to profit when the price goes down, when you're bearish, okay? So in this case, GE, the suckiest stock in the market today. All right, most bearish stock, right? So in this case, you can see GE was on a downtrend, right? As you can see, those of you who have taken my courses, you know how to read trends. You know when it's a downtrend, it's an uptrend. So you can see it's a clear downtrend and $12 over here. So if you believe that the trend will continue, you think it's going to go down, what can you do? How can you make money? Well, you buy a put option. So by buying a put option, let's see what happens. There we go. So on this date, which is 22nd of October, oops, sorry. On the 22nd of October, you buy the GE November 12 put. Again, what does it mean? It means you're buying a put option with a strike price of $12. Okay, so that means you now have the right to sell the shares at $12, no matter where the share price goes. So the share price can go to zero. Who cares? You can sell it at $12. You have locked in the price at $12. But you got to do it anytime before November expiration. Again, the 3rd Friday of November. And again, to get this right, to buy this contract, it's not free. Nothing's free in life, okay? You have to pay a premium. In this case, the premium is 48 cents, which is about 4% of the current share price if you're buying it at the money, right? So let's take a look at what happens. So GE goes from $12 to $8.30. So it's a 30% drop in 2 months. So you bought the put option at 48 cents, again times 100 shares, your total investment is $48. You know, small invest, 48 bucks, right? So the stock price goes to 8.30. What happens? You have the right to sell it at $12, but now it's at 8.30, all right? Which means that technically you could sell the shares at $12, short sell at $12, and buy it back at $8.30, giving you a potential profit of $3.70. Again, how do I get $3.70? It is $12 minus $8.30 is $3.70, right? So now my put options are worth at least $3.70 in value. We call that the intrinsic value of the put option. But again, in reality, it'll be worth more than that because of the time value of the option. But again, it'll be worth at least $3.70. So you bought the calls at 480. Sorry, you bought the calls at 48 cents, and now they're at $3.70. So you sell, sorry, you bought the put options, excuse me, right? At 48 cents, you now sell the put options at $3.70. So what's your profit? Right, it'd be $3.70 minus 48 cents gives you a profit of $3.22 times 100, $322. So you make 322 divided by 48. That's a 670% return on your capital. All right, making money when the burger goes down, right? So that's how put options work. Now, what if you have no idea where the price is going? Okay, so a good example was a couple of days ago on the S&P 500 ETF, the SPY, right? Now, again, you can trade options on stocks, options on ETFs, options on indexes, options on Forex, any asset you can trade options on, okay? So in this case, this is the S&P 500 ETF, the SPY. And you can see that there was a strong resistance over here, right? And it broke out, but it looked like it was coming back down. So at this point, you're not sure, okay, is it going to bounce and go up, or is it going to go back down? You have no idea where it's going to go. But if you think it's going to go in one direction, what could you do? That's right. Some of you have thought about it. You buy a call option and a put option at the same time. What do you call that, right? We call that a straddle, right? Call that a straddle, right? I know it sounds erotic and kinky, and that's a great thing about options, right? You know, options have all these kinky and erotic names. Spreads, okay? Straddles, okay? Don't get too excited. Anyway, so in this case, you could buy, okay, so at this price, you can see that the SPY ETF is selling at $279. All right, $279. So again, you don't know if it's going up or going down. What do? You can buy a call option with the strike price of $279 and simultaneously buy a put option with a strike price of $279. And they both expire in April. So what happens if you buy a call and a put at the same time? You get this. That's right. So using the charting software, it will draw the profit and loss graph for you. So again, in the course, we'll show you how to use all the software so you don't have to visualize it, right? It is drawn for you. You can see the profit and loss as well as the potential profit and loss you'll make at different prices, okay? So in this case, we are buying a call and buying a put at the same time. Now, of course, by doing that, you pay double premium, right? Because you have to buy two contracts, so, right? But what it does is it creates a profit and loss graph that looks like a V shape, all right? This V shape over here, all right? So again, it's called a straddle, right? So you can see that if the price from $279, all right, right now you're buying at $279, right? If the price goes up to, you know, $290 or $300 or $310, what happens, right? You make money. You can make $2,000. You could make $3,000. You can make $4,000. You know, these are all the potential profit you make if the price goes up. But if the price collapses, right, to, again, it goes to 260 or 250, what happens? You also make 3,000. So you make money in any direction. Now, some of you are thinking, hey, what's the catch? There's always a catch, right? Nothing's free in life. There's no free lunch. So what's the catch? The catch is if the price doesn't move, if the price, stays between 270 and 290, what happens? That's right. You will lose money if it doesn't move, right? So this strategy is very useful if you believe the price would go in one direction in a very strong way. For example, there's an event coming like Brexit, or OPEC is meeting to decide on oil prices, or the FOMC Fed is going to increase interest rates. Don't know what's going to happen, but something's going to happen. You buy a straddle, so you profit no matter where it goes, right? So that's how options can be used. Options are very useful because you can construct the strategy to profit in any situation that you want. Okay. All right. Now, the fifth reason to use options is to protect your investment portfolio. Now, again, for those of you like me, you have got an investment portfolio where you buy good companies for the long run that will go up in the long run. But in the short term, you think it could go down because of a recession, of a bear market. And you don't want to sell your shares. You know why? You want to keep your shares because you collect dividends. And if you sell your shares, you're going to pay tax if you're in the US. So, hold your shares. But how do you protect your shares? Well, use a put option. Okay. And we call this protective put options. You're going to learn this in the course. Okay. So let's look at one stock, this P&G, Procter & Gamble, right? So P&G, let's imagine you bought it at $86 and you bought 100 shares. So you paid $8,600. And after you bought it, whoa, it's now at $105. And now your shares are worth 10 grand. Okay. So what is happening now? You are now sitting on unrealized profits of $1,900. Those are your unrealized profits. Now, here's the thing. You think that a bear market is coming, recession is coming, and it could go back down. So what could you do? Well, you could say, I'll just sell my shares, right? So you could, of course, sell your shares at 105 to lock in your profits. But if you do that, what happens? If it keeps going up, you no longer have the potential upside. And once you sell your shares, you don't get dividends anymore. And if you're in the US and you sell your shares, you have to pay tax on it, right? So one reason why Warren Buffett is really rich is because he doesn't pay any tax. And it's because he never sells his shares, as long as he thinks it's a good company, okay? So how does he protect himself? Well, it's kind of like you own a house and there's a fire that's coming and it could spread to your house. What do? You buy fire insurance. So by buying fire insurance, you pay a small premium to protect the value of your house. So if your house catches fire and burns down, what happens? It's okay because you've insured your house for the market price. So no matter if the house goes to zero, you get to collect the insurance policy. You know what's a beautiful thing? You can do the exact same thing in the stock market, in the forex market, in the gold market, in anything by using put options. So if you think about it, a put option is an insurance contract that you buy and you pay a premium to protect your share value. Okay. So in this case, if I want to protect my unrealized profits while allowing potential for future gains, if the share price continues to rise, I could buy a put on P&G to lock in this price. So how much would it cost? Let's take a look. There we go. So again, this is the option chain of P&G. And again, I can choose the length of my contract. Again, you can insure your house for a year, insure your house for 6 months, okay? Your expiration date of the option. In this case, I'm choosing the 24th of May expiration date, okay? And I'm looking at the put options, and I like to buy the 104 strike price. Okay, so again, what does it mean? It means that once I buy this put option, I have the right to sell my P&G shares at 104. I've locked in my sales price. So even if it drops to 100, it drops to $50, I can sell it at 104. But how much does it cost to buy this option? You can see the market price is here. $2.38 times 100 shares is $238. So that's not too bad. So think about it. In a way, you're paying, in a way, you're paying $238 of premium to insure 10 grand worth of shares, right? So that's a pretty good deal, okay? Now, what if it doesn't go down like you expected and it keeps going up to $200? Then the put option that you bought would be worthless. It will expire and you would lose $238. Now, are you going to get upset? Of course not, because your shares went up. It's kind of like you bought insurance on your house and your house didn't burn down. You don't say, damn, I paid that insurance premium for nothing. My house didn't burn down. Of course not. You're happy to pay the insurance, the premium to protect your house, right? Same thing with this, right? But in reality, will we lose $238? No, because we could sell the option before it expires if we think that the house is not going to burn down, and we could get some money back, right? So again, you can sell the option at any time and buy it at any time, right? Now, in the course itself, you're going to learn how to hedge a portfolio with protective puts. Now, again, you say, Adam, but what if I own P&G shares? I own McDonald's. I own, all these shares. Do I buy put options on all the stocks? No, of course not, right? I'm going to teach you that, you see, most of the time, all the stocks are correlated with the market, with the index, the S&P 500. So when you have a portfolio of shares, you just have to buy a put option on the S&P 500 to protect your entire portfolio. We call that hedging your portfolio. And again, we'll learn that in detail in the course itself. Okay, let me just run through the last couple of reasons, right? Next, one of my favorite reasons, number 6, is options allow you to generate additional income from your investment portfolio by selling covered calls. Now, so far, we've talked about buying options, right? Buying calls and buying puts. But besides being a buyer of options, you could be a seller of options. That's right, you could sell options. Now, some people ask me, wait a minute, must I first buy the options to sell it? No, you don't. You can sell an option without having it in the first place. That's right. So you can go into the market and sell a call option. You could go into the market and sell a put option, right? At any time, okay? And remember, when you buy an option, you're paying a premium. When you sell an option, you're collecting a premium. In other words, by selling options, you are now the insurance company. The insurance company sells insurance and they collect a premium. So you can become an insurance company selling insurance, right? So one way to do it is, but before that, let me just say this. Never ever sell options naked. That's how people go bankrupt. Okay, in fact, there was this guy who almost went bankrupt because he sold options naked. So in a course, I'll teach you, you should never sell options naked. And you say, what the heck does that mean? Does it mean take off my clothes? No, right? Don't sell options naked. When you sell an option, you must always buy another option to protect or reinsure your insurance you have sold. And that sounds a bit confusing, but don't worry, we'll get into that in detail, right? So anyway, one of my favorite strategies is to sell covered calls. Let me run into that really quickly, okay? Now, if you are an investor and you buy McDonald's shares and you think that in the long run, McDonald's is going to go up, right? How do you make money? Well, number one, you make money by capital gain. The price of McDonald's goes up. Number two, you collect dividends, although dividends is quite little nowadays, right? But the third way you can make money is by selling call options against the shares that you own, and you collect premium. Okay, and see, as an investor, one of the frustrating things is you buy a stock and it doesn't go up every day. It doesn't go up every month. It doesn't go up every year. There are times when the darn price goes sideways. And in most cases, when it goes sideways, you're not making money, right? You're sitting around twiddling your thumbs, twiddling your fingers or whatever it is, right? So with covered calls, if the price goes sideways, you can make an additional 15 to 20% returns by selling call options above the current market price to collect premium. Now, again, in the course, you will learn the exact details, and there'll be a lot of live examples where Bang and myself will show you live examples of how we do it every single month, okay? But let me just show you an example. So imagine you hold shares in a fundamentally good company, right? Again, you have to hold at least 100 shares. So you can do this for lower price stocks. Now, in the long run, you are confident that the shares will rise in value. But in the short term, while the stock is going sideways or going down or moving up slowly, you can sell out of the money call options. And again, what does out of the money mean? It means you sell call options where the strike price is above the current market price. Okay? And by doing that, you collect premium. Okay? Now, again, how much premium do you collect? Okay? Now, on average, when you sell call options that are out of the money, you normally get a premium of about roughly 2% of the share price. Okay? Which means if the share price is $100, you collect $2 in premium, right? Let me say that's only $2, right? But again, if you do it every month and there are 12 months in a year, that's 2% times 12. That's 24%. Additional return you get on top of your dividends, on top of the capital gain of the stock. All right. So that has been my secret of how I generate really good returns on my investment portfolio. Okay. So you sell one contract of call options for every 100 shares that you own. You collect the premium and repeat the process every 30 to 45 days to generate additional income. Now, I'm not kidding when I say that this strategy is a no-lose scenario. Absolutely. It is a win-win scenario. You cannot lose on this strategy. As long as you only do this on companies that you already own. Okay. Now, you don't specially buy shares to do this. You must already own the shares of the company. And it must be a company that is fundamentally a good company that passes the steps of value investing, which means it's a good company you know is going to go up in the long run, right? So you don't do this on stocks that are not strong companies, right? That's how you get killed. Do this on Dow Jones stocks like Intel or McDonald's or P&G or Coca-Cola. These are the companies you know are good companies, right? So let's take a look at Coca-Cola. Now, again, you know that Coke in the long run will rise. Okay, it's a good company, yeah? But in the short term, you can see that Coca-Cola is selling at $50.50 and it's kind of like facing resistance. Okay, it's at resistance and the price is going sideways or it could be going down, but you don't think it's going to go up very much. Okay, what you do? That's right. You will sell the Coca-Cola call options at a 51 strike price. Okay. Now, again, you sell the call options. Now, as a seller, you collect the premium. In this case, the premium is $1.50. Okay. So again, 150 out of 50.5. Let me do some math, right? So 150 out of 50.5. That's about 3%. 3%. Okay. And these call options that you sell normally have a 30-day expiry, which means in 30 days, when they expire, you get to keep the premium of 150 or 3%. Now, again, if you do this every month and you multiply it by 12 months, that could be 36% return. You make 36% return even if the stock goes sideways for a year. Okay? Now, here are a few scenarios. Right? Now, when you sell the call options with the 51 strike price, what does it mean? It means you're obligated to sell the shares at $51. Let me repeat that. Remember, when you buy a call, you have the right to buy the shares at 51. You have the right to buy the shares at 51 when you buy the call. But when you sell the call, you are obligated to sell the shares at $51. Okay? So, if the share price goes sideways, goes down, what happens? This call option will expire worthless, which means you sold something that expires worthless and you keep the $1.50. Yay, good, right? Now, if the share price goes up to $53, what happens now? What happens is you are obligated to sell the shares at $51, okay? But it's now at $53, okay? Now, of course, the downside is that, heck, you could sell it at $53, but because you sold the call option, you now have to sell it at $51, okay? So in other words, you are limiting your upside temporarily, but you are collecting the premium to offset the potential opportunity cost in the shares, right? Now, some people say, but if I sell the call option, I'm obligated to sell my shares at $51 and I don't want to lose my shares. Now, don't worry, in the course, I'll teach you that for me, I never ever sell my shares, okay? Because the moment the price goes way above the strike price of my call, what I do is I will roll my call. We call it rolling the call. What rolling the call means, I'll buy back the call option that I sold and sell another call option at a higher strike price at a further expiration date. So I keep rolling the call so that I never get assigned, which means I will never have to sell my shares. Okay, so that causes a win-win scenario. And again, you learn the details of how to do that in the professional options trading course. So to answer the question, I will never sell my shares. They will never take my shares, okay, no matter where the price goes, okay? So these are the trade secrets that we use. So with that, let me introduce the professional options trading course. Now, this course was created by Pham Van, my good buddy, and Pham has been trading options now for 17 to 18 years, right? So I would say that in terms of options, he's one of the best option traders that I know today. And that's why I work with him. I co-developed the course with him. And together we'll be teaching you this course and we'll be mentoring you along the way to support you to answer all your questions to make sure that you really understand and master these skills. As you know, for all my courses, you've got unlimited access for the rest of your life. So you never have to worry that you have to finish the course in a certain time frame. No, you've got unlimited access, number one. Number two, you've got unlimited support. So as long as I'm breathing, as long as Pham is breathing, we'll be answering your questions every single day to ensure that you understand what's going on. We'll also have live webinars on Q&A. On questions that any questions you have, we'll have upcoming live webinars to answer your questions live to ensure that you really understand this, right? And I can say that this is the only professional options trading course. We're going to learn really everything in detail, okay, to allow you to do it successfully. Now, let me run through the curriculum. They're all together 9 lessons. And after I finish this, I'll then answer the questions you have posted in the last hour. All right, guys? Okay, yeah, all right, great. So lesson number 1, you'll be learning the basics of options trading. All right, so you're gonna learn all the basics. right? What's a call? What's a put? You learn about intrinsic and extrinsic value. And really important, you must understand the Greeks, which is the delta, the gamma, the theta, the vega, the rho. Now, what the heck does that mean? Basically, now a lot of people ask, hey, which option do I choose? What strike price? What expiration date? Now, it all depends on the delta, the gamma, the theta, the vega, and the rho, all right? So you need to know all these things before you choose the best option for the situation. And again, I can tell you that you're going to learn it in a very simple way that, a 9-year-old will understand, okay? My dog will understand it. No, maybe not my dog. Anyway, my wife would understand it, okay? And again, how to profit under any market situation. Lesson 2 is the practical stuff. So again, how do you use the charting software? Okay, how to set up your charting platform, how to create a watch list, how to analyze the option chain, how to analyze the profit and loss chart, how to place, modify orders and cancel orders. So again, all in detail, right? So again, my preferred broker, which I use, is Think or Swim by TD Ameritrade. You can also use Options Express. You can also use a Tasty Trade. You can use Interactive Brokers. All these brokers will have the same features, all right? Now, lesson number 3, you'll be learning about how to buy long calls and long puts. Again, exactly how do you execute these trades? What strike price, what date to expiration, so on and so forth. Lesson 4 will be, again, how to sell covered calls. Again, for all these lessons, we'll not just go through the steps in detail, but you're going to have a lot of live trading case studies where you're going to see live trades that Bang and myself, we use every day, and how we take profit, how we cut our losses, how we manage the trade. Lesson number 5, how to hedge your investment portfolio with protective puts. Okay. Lesson number 6 is how to own stocks at a huge discount or even for free, like Warren Buffett. Again, we call this the cash secured put strategy. Now, lesson 7 and lesson 8 are one of the most powerful lessons. Lesson 7 will be on buying vertical call spreads. Lesson 8 will be buying vertical put spreads. Now, I didn't have the time to go into this because it takes a couple of hours to really teach this in detail. Now, basically, what is a spread? Now, again, nothing erotic, okay? But you see, you can just buy a call option, okay? But what is the disadvantage of just buying a call option? So if you think the stock is going to go up, you could buy a call option, right? But if you buy a call option, you have to pay the premium, okay? So what we do is this. If we think the share price is going up, we buy a call option at the current market price, but we simultaneously sell a call option at our target price. Now, why do we do that? Remember, when we sell a call option, we collect the premium, and we then use the premium to finance the call that we bought. There you go. Genius, right? So in other words, instead of paying for the call option, we sell another call option at a higher strike price and use that money to pay for the call option. So by doing this, our capital is even lower than buying the call option. Okay. The other thing is when you buy a call option, as the time passes, your option is losing value. We call that time decay. Okay. But by selling another option, it offsets the time decay so that you're not affected by time decay as well. And that's why we call this spreads are very, very profitable compared to just buying the call. Okay. Now, the same thing with puts, you're going to learn how to buy vertical put spreads. Now, finally, lesson 9 will be the bonus lesson, which is going to be on technical analysis. Now, let me tell you the main difference between this course and other option courses that you can take. Now, In other options trading courses, guess what they teach you? They teach you all about options, and that's it. They don't tell you exactly when to execute the specific option strategy. They may say, hey, okay, do this when the market's going up. But how do you know it's going up? Do this when you think the market is going sideways. How would you know it's going sideways? Do this when the market is going. How do you know it's going down? Right? They don't teach you the technical analysis part of knowing where the trend is. And to me, that's one of the most important things. Let me give you an example. Now, I was in the army for 2.5 years, and I've continued to be in the army for 10 years after that. So if you've got a bit of military experience, let me give you an example, right? Now, when you learn options, it's kind of like you're learning a new weapon. Like, it's like a grenade launcher or an anti-tank missile, okay? But here's the thing, I can give you the best weapon, the best anti-tank missile. But if you don't know how to aim, if you don't know how to duck, if you don't know how to prone, if you do not know how to move around, guess what? You're going to get killed by the enemy. You get the point? So many option courses out there, they give you the weapon, but they don't teach you how do you aim the weapon, how do you move around. And that's where the technical analysis part comes in. All right. So if you already are a good stock trader or stock investor, you're great at aiming, you're great at ducking, and you have got an M16 assault rifle. And that's great. You continue using your M16. But with options, you now have a grenade launcher or an anti-tank missile to complement your M16 and to improve your success in the war or in a battle to make money. Got it? All right, great. So that's the options trading course. And here's what you're going to get. Basically, the options course, we called it the options Ironshell, 9 lessons, okay, 803 minutes of recording. And we're also going to have a series of live webinars to answer all your questions. Okay, so no worries about that. The total value of this options course is 1588. And again, this is an unlimited lifetime access. So even after I die, guess what? You can still watch the videos. Next, you'll be getting dedicated email support, unlimited questions that will be answered by our team of mentors. And you'll be getting our first bonus, which is our options proprietary trading tools created by Pham. So he has created these proprietary tools, which is the covered call scanner and the cash secured put scanner that will scan for the best stocks to sell covered calls on or to sell cash secured puts on. You will also be getting a options trading quick reference guide. All right, so these are the bonuses you'll get. So you'll be getting a total value of 2964.